Hi, this is Kim Watson. Welcome to my video. I'm just looking here at margin and how it's getting in a lot of traders' way. And when I say getting in their way, the rules were changed in the UK and well, in Europe, and the UK as part of Europe, it followed the same rulings where the amount of money that you had to have in your trading account to trade a specific volume of currencies was increased significantly. So the idea is you had less leverage, in which case you couldn't trade so much. Now in the US, Australia, and many other countries, South Africa, the Middle East, Far East, and just about anywhere else, you watching this, it will teach you about margin, but it won't teach you or help you too much aside of that. It really will talk about margin and leverage. But what I'm looking at here is how we can find the loopholes, where the loopholes are in terms of traders that are struggling to trade with modest accounts, which a lot of people start with, and how they can actually work their way around these ESMA rules, these European rules. Okay, so the principles of margin itself, and it's the first that many traders come against margin is the day that they very first open their account up and they're not too sure of what the sizes mean within the trading account in the first place, and they just go for it and they think, well, I'll have one of those, and they're probably looking at a one standard contract. They go to press the button to trade it and they realize, oh, actually I can't trade that because it's telling me here I haven't got enough money in my account. So margin, I'll run through what it is, but that is the amount of effectively a deposit there. Then there's a slightly better understanding of leverage by some, but even so, it's not fully clear to all. So I'll run over these as they are here. Margin is the minimum amount of money you need to have in your account to place a trade on a leveraged asset. Now, a leveraged asset can be anything from a CFD, pure Forex accounts that we trade, spread betting. An unleveraged asset would be something like a share that's not traded through CFDs. It's just purely, if you were to buy 50 shares in Amazon, you just buy the 50 shares and you own the 50 shares. You would have no margin on that at all. You'd be paying the full amount. It's only, as I say, when you're using anything that gives you leverage, are you then anything using leverage, you need to put a deposit down. Now, leverage itself is the ratio of the deposit versus the notional value of what you're trading. So I'm going to give you the example straight away here. A standard $100,000 contract, for example, with a margin requirement of 1%. Now, in ESMA terms, it would be 3.33% effectively, but in anywhere else, it would be 1%, or it used to be 1%, or even 0.5%, where you're getting 200 to 1. But 1% would require $1,000. So that $1,000 equates to 100 to 1, or expressed as 100 to 1 leverage. So you're getting 100 to 1 leverage. You're controlling $100,000 with $1,000. Now you can see where this went wrong for a lot of people, in terms of they would load up their account, they'd put probably $1,000 or just over, or they'd be putting $1,000 in because you can get plenty of brokers, and the broker I'm looking at actually recently added to our Best Brokers Online website. It's a broker that in some of the pairs, such as euro dollar, only requires an 0.5% deposit, which means that you only need you're effectively getting 200 to 1 ratio leverage there. So you're needing even a lesser deposit. Now, there's swings and roundabouts here, and as I said, the problem is in the way that ESMA saw it, the FCA, etc. How they saw it was that people were coming in, they're putting $1,000 or just over into their account, £1,000 maybe, and then trading one contract, and that one contract, if it went against them, would start knocking away at the margin. They would get margin calls. They'd have to add money. Sometimes they got a bit lucky with it, and they started. Oh, they could make 30 points would make them $300 at this rate, at that leverage, and it becomes. I've just made $300 on my $1,000. I made 30%. Whee! And that's unfortunately. That there was that mentality. Now it sounded great, but you've got to be careful, and you could just as easy have lost $300, in which case you would have lost 30% of your account in one trade. So there's a double-edged sword, as they say. Now, here's a little chart here, initial margin required. So this is the margin that's required, and this is the leverage it would equate to. So if you're being given 50% margin, you're getting leverage of 2 to 1. This is the current European Forex levels, 3.33, which is given approximately 30 to 1 leverage. And the a 2% was a lot CFDs are sort of around this 2% to 3%, 5%, 2%, and things like this. You're getting effectively a 50 to 1. On Forex, it used to be 1% or less when you were getting 100 to 1 leverage. Now, the more intelligent out there would think, well, actually, if I was only needing to put 1% down rather than 3%, I could still trade at the right sizes, but I wouldn't need to have all my money tied up there, and I could trade better. And I'll explain what I mean by that in a moment. Now, when you're working this out, you would still be using if you're using a smaller account, you still can calculate the size of your position, and you can take the relative size position relative to the stop needed, etc. So you're not exposing yourself to be much more than that sort of 1-2% sort of level of risk. So let's say you were trading a mini lot, which is 0.1 of a lot, so it's a tenth. That would require a margin of just $100 in the old terms. With ESMA, that same 0.1 lot in Europe, basically, you're needing a margin of $330 to trade the same thing for the same targets, for the same everything else. And this is where, unfortunately, for a lot of traders, it actually makes it much more difficult. It tends to tie their hands somewhat. So what it means basically is that a good trader cannot trade properly unless they have a decent size account. So too smaller a size account. So now you're effectively saying, actually, you've got to risk or put aside more of your money on something that you're just learning about, as opposed to accepting, well, okay, you may just want to put 2,000, 1,000, 2,000 in an account, and that'll be what you're opening it for. Instead, they're insisting you either put more in or trade smaller and less. But the problem is, it can become quite frustrating as they have to trade on the minimum size often, which means that they cannot close part positions. So, for example, if we were opening a position and it required a 40 pip stop, so you've got to work out what a 40 pip stop would be and what sort of size you can trade to make sure that's 1%. Now, some people would immediately, with the way things are going, not be able to do too much at all, but you'd work out the size of the position you could trade with, and then from that point you would calculate your size, but then it could end up that you're at minimum size. So you can't trade because there's this bigger stop, and particularly if you're swing trading, a bigger stop can mean that I can only take the absolute minimum size, whatever it may be, with that broker. Some do micro accounts, which is good because you can go to 0.01 of a standard contract. So it gives you more chance to be able to do something. Some brokers don't do this, and it's particularly when you're spread betting, it's often 50p as the smallest size position. So it makes it quite difficult relative. This is relative to about 6 pence, 0.01. 0.1 is about 60 pence, and a normal contract would be about 6. Well, I say 6, it's probably much more than that. It's about 7 or 8 quid now, with a weaker pound. Anyway, So it's probably 77 pence then, 7p. Anyway, so what I'm saying here is that you're effectively, if you can only take the minimum size, if you were trading a market and you sort of got the first target here and then the second target up here somewhere, you either don't take that first target, you take the money off at that first target or the first half, because you can't, because you're trading at minimum size. So you're stuffed basically. So you can't trade as in where you may be protective and take that. You've got to risk it getting all the way up there. Now it may not get on all the way up there and roll over. So if you haven't taken the size, okay, you can say, well, actually, at that point, I'll move when it breaks past, I'll move the stop up there. But you do that, and you just get moving the stops. It's just too quickly. It might just move back through that area and go back up and hit your target. It's really adding an element of risk to something that's already got risk. So you're effectively having to micromanage, or you end up traders often end up micromanaging for something they shouldn't be micromanaging for. Now, swing trading is even wider swap, and there you go. As I said here, you often end up micromanaging. You use a smaller stop, or you end to move the stop up, because the margin in your account is being used up on one or two of these trades. For example, you use $1,000 account here. Let's say you decided to open 0.1 lots. It's got a really modest stop on it, and you've worked out it's fine. It can fit in there. You'd need $330 to open that account. Now, if you already had two positions running there, they could be up in profit. So you'd be using $660. Now, to open that third position, then that's going to take you up to $1,000. So even if they may be up in profit, it might let you press the button. But the risk is you've got to maintain that margin in there all of the time. So if you start losing money, then you've got to either top it up or close the position. Which brings me on to margin calls, and this is what some traders may experience: is the email or the phone call saying that your account has insufficient margin because such an event. Whereas, just coming back to this, I mean, it wouldn't be if you're swing trading, you may have two different currencies being swinging. You may be wanting to day trade. Okay, the argument is we've put more money in there, but well, that's one argument. Maybe people can't afford it or don't want to put any more money in. They just want to get the learning stage done, and they understand risk, so they don't want to cheat the system or anything like this, or go out and push and try and get that $1,000 or that massive full, all-in type position. They're measuring things correctly, but unfortunately, the markets and the way the rules are set doesn't apply for us. Now, with the margin call, so if you have insufficient margin, you get asked to increase it. Most brokers will hold the positions. Now, some of them will hold them till they hit the 50% level, at which time they'll just close the largest position first until the account has sufficient margin to maintain the other positions, or until all the positions are closed, whichever is needed. But they will close those positions down. They'll have them all triggered off. There won't be anyone sitting there necessarily to watch them, but you'll get either a call, an email to say you've got insufficient margin in your account, some sort of notification. And unless you either add money to it, which seems like the wrong thing to do in a sense, if you're trading, they're effectively, well, I say it's not the broker that's affecting you. The rules are affecting you because the leverage that you're being given there, the reduced leverage, means you've got to have the same money. If you run this back, just run this back to this example here. If you were trading these normally, that would be $100, $200, $300, so you'd have $300 tied up there. It doesn't mean to say you need to use everything in your account. But you'd only have like $300 for the three positions, in which case you can properly money manage your open positions. You can, if you need to open a 0.2 lot because you're going to close, 0.1s generally, if you can go down to the micro side, you can reduce the size anyway, so you go to 0.05s and things like this, so you can reduce that size. But if you were on 0.01 or whatever it may be, 50p a point or whatever it may be with the spread better, you could probably go for £1 a point and then be able to trade it properly. But you'd only, okay, your leverage is more, you've got more risk in there, but providing it meets the criteria and you're not losing more than 2% of your trade on any one of those trades, or 2%, or risking more than 2% of your account on any one of those trades, it should be fine. But you can see the difference that this makes, and it makes it very difficult for traders to trade properly. So the other thing to bear in mind with the margin calls, and seen this lately with the high volatility, when volatility, you may find that the broker takes action quicker in more volatile markets. They tend to start reacting. I've already seen one or two brokers increasing the margin requirements that they're asking for CFDs on stocks. Each broker can always change their rates, and they reserve the right to change the rates at any time without notification. So they can change their rates anytime they like for a justified reason. They need to ensure you do not lose more than your account size, because all European accounts have to have a safeguard effectively, so you can't lose more than your deposit that you put in. So if you put $1,000 in, you can't lose anything more than that $1,000. You can't be left owing anyone any money. So hence why they are so strict. That's why these margin rates are high, but as I say, I think they're too high to be practical for a trader with a smaller account to trade properly. As I said, you can argue people should have more money in their accounts, but it's the wrong way in a sense if you want to trade with a modest account and get going and learn the skill first. Now, there are some loopholes. Well, before I talk about loopholes, I guess one of the things is you could, with your account, if you're finding your feet and you're actually about there making some money, you could be adding each month into your account. So you could sort of build it. You even put $100 or 100 quid a month sort of running in to build that account, the account up that way. So it's a sort of a potential way of using the account. But loophole wise, a lot of brokers from the offset started opening offshore accounts. Now, the FCA would look badly upon these brokers if they said, "I'll go and open an account offshore," but we can do that, can't we? We can tell you which ones have got good offshore accounts. There are a lot that got opened in Gibraltar and Malta and everywhere else. That, in fact, I think it was XTB, one of the brokers on our Best Brokers Online website. The chief executive mentioned that I think they had lost 20% of their volume in the first month or two because people just moved offshore straight away. So people are moving off this. Of course, the other, I say it's not a loophole, but if you're a professional trader, deemed as a professional trader, you can trade at the higher risk levels. You can have the 100 to 1 or 200 to 1. But let's be realistic about these things. One thing to ask if you're going into these offshore sites is, where's your money held? It's very, very important to know where your money is held, because if it's held in places where you don't think you'll get it back, I wouldn't be looking to trade there. And also, we still have the guarantees in terms of you can't lose anything more than what you've put in there. Effectively, the deposit you've put with that broker, we still have the guarantees. These are important factors to be considering. Now, I mean, if you're European-based, one such broker that it comes very well regarded is core spreads. Now, I mean, they're good in the UK. They've obviously got a company over here and FCA regulation, etc. But I do know the guys there, Stuart Lane, the chief executive, etc. And they're a good bunch. We've known the chief executive for a long time now. By going through to the brokers and finding core spreads, you could find out more about them here. But by using the links that I've actually put on here, it will take you through to an open an offshore account. They can't suggest you do this sort of thing, but there's nothing stopping me pointing you in the right sort of direction. A few things about them. Basically, they are a market maker. They're a spread betting company, so core spreads. They work on spreads. They work on a very tight spread. Now, I checked these out today, and I've just updated them. These are the sort of spreads. These spreads are thin, but they can do this because they're not making their money from the spread so much as they are taking. They are a maker, a market maker. So for the money that's lost is effectively only lost predominantly to them. They can hedge their books out to the wider market. If you've got your B book, which is doing particularly well, or your A book, whichever way around you're doing it, but that market that's doing particularly well, you can hedge the traders that are doing well. You can hold on to the money, so they can afford to put very tight fixed spreads. Even when the market is going flying, you can run in with these spreads. So there's opportunity. Now, I always used to sort of frown on this sort of thing, but the very fact that they've been very straightforward in terms of this is one of the simplest brokers I've seen for a long time. You go onto their platform, you can watch how to trade off their platform and everything else. I do teach on all of this site, actually all the brokers that we got listed here. I'll go through their platforms, but you can run through. It's got to be the most basic platform I've come across by far, which is in a sense quite a good thing, because all those bells and whistles often get people completely befuddled. Here it's that's a very technical term, by the way. Here it's all very simple. You just literally find out what you want to trade, click on it, opens a ticket, click on the ticket, but you can watch through here. So it's, as I say, if you use this, it will take you directly through to the core spreads, and you will be able to have trading margin of 0.5 on the euro dollar with what they're doing. So you're using a lot less of your money to do it. Now, it doesn't mean say you can go wild, but what it means is you can trade properly, and that's, I think, much more important. That's you can, as I say, you can read more about this. You can open the account from here or do what you like. There's more about the broker there. All the important things there I talked about a moment ago is the fact that you can your money, although it's in a South African office, the money stays at Barclays in London. It doesn't go from there. It's held there in a segregated account, as you would expect. And as with European legislation, they meet those same responsibility throughout everywhere they operate, South Africa, Australia, etc. You can't lose anything more than you deposit. So it's a good broker. So there you go. That's a bit of a loophole around it. If you're getting frustrated in terms of what you're doing at the moment, as I say, they're a good broker, but it will give you more opportunity to trade properly. Okay, that's it. I hope you find this video useful. Bye for now.